Thank you very much, Bill, for this very personalized introduction. Usually my bio is about 10 lines, and we read every line of it, so it's very nice to have this warm welcome. And a pleasure for me to be surrounded today by actual physical traders, commodity traders in what we call the real sector as economists. So I am an economist. I lead the macroeconomic research efforts for Standard Chartered Bank here in Dubai. I've been doing that for about 13 years. And I'm happy to be with you today to share a bit of context on what's happening within your micro industries, within the cotton, the textile industry, really taking a step back and zooming out into what global and regional macro drivers set the scene and contextualize these trends that you are experiencing firsthand, day to day in your own industries. So my name is Carla Slim. If that sounds familiar to Carlos Slim, it's because some of you do have experience with Mexico, but we're completely different people, not related, actually a little bit related since he is originally from Lebanon, but yes, very much focused on macro rather than telecoms on this side. So the structure that I have today, I will not be using slides. Hopefully everyone has got their coffee during the coffee break and caffeine levels are running high. But what I was trying to do today is to structure this update into really three key parts. I'd like to talk about the global economy first to set the scene at a global level. Your last speaker left you with a very interesting conclusion and takeaway. So Joe had said that watch out for the value of the dollar and any trade deals that get agreed from here. So I'd love to pick up from that last point. I will be talking about tariffs and trade. We'll be also talking about global inflation and the value of the dollar in that. And we will be talking about global interest rates as well, as we see some divergence in the global economy. So that will be my sort of agenda on the global front. And then it would be great to delve into the regional macro trends as well, derived from the global macro, and focusing on inflation within our regions that is very different to the global inflation picture, the growth outperformance that we're seeing in the Middle East and Pakistan, and FX risks, so ending right where we'll start, talking about that dollar and implications for FX in various markets, and what risks we should be watching out for. So we're going to have a lot of optimism, a lot of positive macro messages that I'll be sharing, but we will balance it with the key risks to watch out for, specifically stemming from the global economy and different drivers that we're seeing. Before I get started, I'd love for us to prompt the QR code again on the screen. I will be receiving the questions in front of me, and we will have time for a Q&A. So please do send in your questions as and when we go. I would love to hear from you what's top of mind and what's concerning, or really the opportunities that you see in your industries, and weave them into the conversation as well. So you'll see I can talk a lot, but I can also listen to questions quite attentively as well. So please do scan the QR code and put in your questions as and when we go. So to start right where your last speaker left off, on tariffs. As economists, when we look at the year 2025, since President Trump was voted in, you'll see that market expectations have changed and evolved dramatically. Despite the fact that President Trump was elected and his campaign was all about tariffs and he was very vocal on what he was planning to do, the market did not take him at face value. The market kept discounting exactly how much tariffs he would actually implement after he got elected. And then once he came into his administration, what the market quickly had to realize is that he was putting his money where his mouth is, and we saw a repricing and a volatility shock around April on the so-called Liberation Day when these tariffs rates were announced. So we've seen a lot of volatility in markets and amongst the analyst and economists community about how much to price in and what to price in and what policies, whether on fiscal policy or monetary policy, we should take into the price and take out of the price. So when we look at the year 2025, for us, it's really a year of two halves. When we look at the first half of the year, the key feature of the first half of the year was tariff uncertainty. This going back and forth on what exactly the tariff rate was going to land at and what trade negotiations were going to work and which trade negotiations were not going to work. So that's how we characterize the first half of the year. Many analysts had very negative expectations. There were probabilities of global recession for the first half of the year. There was probabilities of stock market meltdown, which we never saw happening. There was a lot of focus on China, the fact that China was already slowing down and that China would slow down even more because of these tariffs. So what we actually saw was that H1 ended up performing better than expected. The first half of the year surprised positively. We saw exports from Asia to the rest of the world, from China to the rest of Asia. We saw exports outperform rather than exports falling as a result of tariffs, because these tariffs were not implemented yet, and we saw front-loading of these exports from China and Asia to the rest of the world. So this led to what ended up happening in the first half. The actual data turned out much better than what analysts had feared and were concerned about for the first half of the year. So this is why we characterize the first half of the year as marked by tariff uncertainty. The second half of the year, this uncertainty went from just being a risk and a concern, and that front-loading was replaced with actual tariff implementation. And this is where we now expect to see, and we are already seeing, the economic data turn negative. So whether we look at the US, whether we look at China, the economic data is clearly more negative in the second half of the year compared to the better than expected first half of the year. In the US, the weakness is emerging in labor data. We're seeing labor data collapse. We're seeing inflation already increase. And in China, the mixed bag of economic data that we have shows that tariff implementation has begun to bite as well. But on average, for the global economy, what this means is that we still don't expect a global recession. We do expect a global growth slowdown, so we might see global growth fall from an average of about 3% to perhaps 2.8 or 2.7%, so a slowdown in global economic activity, but we're not expecting a global recession in our base case scenario. It's really a tail risk or a worst case scenario that we see. So where does this leave global inflation? The global inflation picture is quite mixed. When we look towards the US, we know that US tariffs are inflationary for the US consumer. It doesn't mean inflation for the rest of the world. On the contrary, when we turn towards China and Asia, we're expecting, and we're already seeing, inflation in China and the rest of Asia to fall. So we're expecting disinflation in China and Asia as a response to higher US tariffs and higher US inflation. We know that China will try to discount goods as it tries to reroute trade that was meant and destined to the US to the rest of the world. And this is likely to be disinflationary, not just for China, but also for the economies that import these goods from China. So we'll have imported disinflation in some parts of emerging markets and frontier markets. So the global inflation picture is quite mixed. Higher inflation for the US does not necessarily spill over into higher inflation for the rest of the world. So we are in a situation where we have a global growth slowdown, a US growth slowdown, higher US inflation. So this is why we call for stagflation risks in the US, and lower inflation in the rest of the world, which is allowing and enabling central banks to continue cutting interest rates quite cautiously. So when we look at global central banks and global interest rates, and that was my third point on the global economy, we have a quite divergent path for interest rates globally. In Japan, we are expecting and we're seeing interest rate hikes. In the US, the Fed has just resumed its interest rate cuts after a pause this year. They had not cut interest rates up until the last meeting, the last FOMC meeting, where they resumed interest rate cuts. The market is now pricing in another 100 basis points of rate cuts until the end of 2026, which many market commentators, including ourselves, as a global research team, we believe this 100 basis points of easing is much too aggressive in this context of higher inflation. Yes, US policymakers are calling the impact of higher tariffs on US inflation transitory, temporary, but it wasn't very long ago after COVID that the Fed also called the cost of living crisis transitory and temporary. While this time around there's more fundamental reason to believe that tariffs will have only a one-off effect compared to the cost of living crisis that was really a disruption of supply chains, we're not expecting inflation to be very sticky, but still to call for a full 100 basis points easing in the next few MPC meetings for the Fed means that we're looking through the higher inflation that we're expecting to see, and that's a little bit aggressive from our perspective. So the other divergence that we're seeing in global interest rates, other than the geographical divergence, where in Japan you have hikes, in the US you have cuts, and the rest of the world is also using lower inflation to cut interest rates cautiously, the other divergence is on the term premium and the structure of these yield curves. We're looking at short-term interest rates potentially falling on Fed cuts, but long-term interest rates, especially in developed markets, are rising. And we keep getting this question from our clients that we talk about monetary easing and allowing lower interest rates to support the economy in this tariff environment where we are expecting lower growth, but how can we see and envisage higher interest rates in the long end when we're talking about such aggressive interest rate cuts in the short end? The answer to this is exactly on the consecutive shocks that the global economy has experienced. We've had consecutive shocks really back to back, to the extent that global central banks are now grappling with themes that we didn't expect to be grappling with on a structural basis. Issues like de-dollarization, global central banks buying gold, and it's funny that we talk about gold today when it just crossed $4,000 per ounce this morning. These trends really reflect the fact that the market is grappling with more than uncertainty and volatility. It's what I like to call unpredictability. So we've been used to uncertainty and volatility since the COVID shock, and I would argue since the 2014 oil price shock. But the paradigm shift that we're in today is one of unpredictability. It has become increasingly more difficult for global financial institutions and even the average individual today to make consumption and investment decisions with some level of clarity. This is the policy unpredictability paradigm shift that exists today, and it's the main reason that is fueling gold prices, but also Bitcoin and crypto prices to act as safe havens at a time where the US dollar is not gaining and maintaining its key role as a safe haven for these times of unpredictability, given that a lot of the uncertainty is emanating from the US itself. So as a global research team, we're not big believers or big subscribers of de-dollarization. We are a global financial institution, so we're one of the 6 global systemic banks globally, which means that we see a lot of the dollar flow, and there is no significant dollar selling that we see from our own clients. But there is a shift in capital flows globally where more financial institutions are choosing to park their capital in gold or in other assets that are deemed as safe havens as this unpredictability folds out. So for us, it's a cyclical trend rather than a structural trend that we see from here. So to wrap up the sort of global economy update, for us, tariffs are now in an implementation phase, and this is when we expect to see the pain emanating from global and major economies in the world, namely China and the US. Global inflation remains quite mixed. It's not a one-size-fits-all that tariffs raise inflation everywhere. On the contrary, they raise inflation in the US and they drop inflation elsewhere in the world. So inflation should not cause a major global issue, we believe, in 2025 and 2026, but it will cause a divergence in global interest rates, both geographically between East and West, and also through the short term to the long end of the curve as well. So having said that now, I'd love to bring all of these themes closer to the region. We are having this conference in Dubai today. I understand this conference is held in different geographies at every edition, but we are in Dubai today, so I'd love to spend a little bit of time to discuss how the tariffs have or have not impacted the Middle East and Pakistan region so far and what we expect to see. So I'll talk a little bit about the impact of tariffs and the indirect consequences that we see in terms of the macro outlook. And then we'll talk about inflation within our region as well and how it's different from the global picture I outlaid. I also want to spend some time talking about the growth outperformance in our region, because when we look at the global economy, there are a few bright spots that we still see despite this negativity and negative economic consequence from the tariffs. So we identify India, ASEAN, and the GCC non-oil economy as the three bright spots within the global economy, as the US and China are expected to continue slowing. And finally, I'll end where we started on FX risks, talking about the relative weakness that we're seeing in the dollar and where we should be aware of FX risks and what are the drivers of the various FX risks that we expect to see going forward. I'll encourage you, again, to drop your questions, if you have not already, on any of these themes that I'm laying out, or any other themes as well that's on top of your mind. So getting right into the tariff impact. So we discussed the tariff impact at a global level. At a regional level, our Middle Eastern region is actually quite unique compared to the other regions with regards to the direct and the indirect impacts from tariffs on the macro outlook. So when we separate the direct impact and the indirect impacts, from a direct perspective, we see very, very little, very minimal impact from the tariffs on our geography, on our region. And the reason for this is that the Middle Eastern trade exposure to the US has, throughout history, been reduced to such a minimal level that it doesn't matter anymore whether the GCC and Egypt and the rest of our region is slapped with the minimum rate of 10%, the universal rate, or any other higher rate. Because when we look at the data, only 5% of Middle Eastern exports go to the US, and in total, there's only about 50 billion of trade of exports that go from the Middle East to the US, of which half are energy, so they're not in scope for tariffs. So we're talking about only $25 billion of Middle Eastern exports from this region destined to the US that are in scope for tariffs. And this is why we say that the impact of the tariffs on our region is quite minimal on growth. We don't expect to see major downside on economic activity or on trade activity as a result of it. On the contrary, there could be opportunities that get created from these dislocations, from these disruptions in trade, that this part of the world can capture in terms of market share. And so we expect trade activity to remain very buoyant and a key driver of growth. Now, the indirect impacts of the tariffs are much more important and have the propensity to hurt economic activity. One of this is oil prices. So obviously, we've seen relatively lower oil prices since the beginning of the year, but also for a while now. OPEC has been in a policy, OPEC Plus has been in a policy of adding production to the market, which I could argue has been relatively well absorbed. Currently, we're in a program where OPEC, or a plan, where OPEC is expecting to add about 140,000 barrels per day every month to the market, but over the last few months, they've added even more. So we are in a situation where there's more supply of oil in the market, and oil prices have held relatively steady since the beginning of the year at this sort of 65, hovering around $65 for Brent here, obviously, not WTI. So Brent has hovered at around $65 plus or minus since the beginning of the year, despite all of this additional supply that OPEC Plus is putting on the market. So we have a combination of relatively lower oil prices and relatively higher oil production that is likely to keep oil prices relatively low going into the end of the year, but into next year as well. This is helping provide a benign global environment where the combination of relatively low oil prices, relatively weak dollar, and falling interest rates from the Fed specifically, this provides a really conducive environment usually for emerging markets, frontier markets, and our part of the world and the Middle East. It provides a subdued and benign global backdrop to specifically the regions that are doing well and that are outperforming like ours. The other indirect impact from the tariffs is on capital flows and trade flows. So there's a lot of concern about rerouting global supply chains, shifting global trade alliance, deglobalization or the change in globalization, all of these themes on nearshoring and reshoring. What we think this is going to end up doing from a trade activity perspective is that we believe that within emerging markets, intra-regional trade is set to increase. So countries will trade more with their neighboring countries rather than these big corridors from east to west and from west to east. So this intra-regional trade will contribute to more trade activity just along different lines, different routes. And for hubs, for regional hubs, such as the GCC and the UAE in particular, we believe this is a huge opportunity to grasp a larger market share, specifically along the Asia-GCC and the Asia-Africa trade corridors, where we expect more impetus for growth along these trade corridors. Then on the capital flow front side, what the tariffs have also enabled, and President Trump's administration has enabled in general, is a rapprochement between the US and the GCC on the investment corridor. So just when the GCC was about to pivot east from an investment perspective, the US pulled it back closer to the Trump administration to refocus the global investments of the GCC on AI, on US tech, on the semiconductor chips, so that both the GCC and the US can benefit. The GCC obviously benefits by being able to source these AI chips, the semiconductors, to be able to power the data centers and that strategy that it's pursuing. And the US benefits from being able to front-load foreign direct investment, FDI, into the US economy and activate the economy as it starts to suffer from the impact of the tariffs. So capital flows and trade flows will be divergent. On one end, the GCC will trade more with Asia, but invest more in the US. So this is how we see capital flows and trade flows readjusting and the indirect impact of the tariffs as well for our region. Now, if we move to the second point, which is on inflation, we've talked about the global inflation and how global inflation remains very mixed across different global economies. But for the GCC and for the Middle East, what we're seeing is actually inflation is not a problem in our region. It was not really a problem during the cost of living crisis, but we're seeing subdued inflation within the GCC, with the exception in the wider MENAP region of Pakistan, Turkey, and Egypt. So these three countries have their own idiosyncratic issues, often related to currency volatility and currency depreciation, and the pass-through from their FX rates into inflation that causes inflation to be above the central bank target or historically slightly higher. But for the GCC, what's been really driving inflation, positive inflation, over the last couple of years since the pandemic recovery has been housing. So the housing sector, the property market, has contributed through higher rents to positive inflation in the GCC. But otherwise, when we look at other elements or items of the CPI basket, like food or energy, these items have contributed to subdued inflation, partly thanks to subsidies in various economies where we see energy subsidies or food subsidies that have kept inflation in check. In addition to all of this, we have a business cycle where the Fed is easing and expected to ease further. And so given the dollar pegs and the fixed exchange rate regime that the GCC has with the US dollar, we are expecting lower interest rates in the GCC to continue fueling economic activity and supporting economic activity, particularly in those property markets and those housing sectors that have already benefited from a boom. So whether it's Dubai, Abu Dhabi, Riyadh, or the Doha housing market, we expect lower interest rates to support activity there, and consumption growth is also likely to benefit from this. As mortgage rates drop within the region on the back of lower global interest rates and lower Fed rates, we are likely to see disposable income of households be a little bit more comfortable, and so consumption growth in the UAE and Saudi Arabia should also benefit from lower interest rates. So here I'd like to take a moment to talk a little bit about growth specifically, the growth engines in the GCC. What exactly is driving the outperformance of the economies of the GCC compared to the rest of the world? Because we talk a lot about how Saudi is growing fast, is accelerating on the back of the Vision 2030, the investment projects, the giga projects that Saudi has. There's a lot of misconceptions about recalibrating of these projects and the impact there in the context of lower oil prices. There are a lot of misconceptions around the UAE housing market, how resilient really the UAE economy could be to potentially a Russia-Ukraine ceasefire, for example. So I'd like to delve a little bit on what breaks down growth within our region and how we see the outlook going into 2026. We have a GCC non-oil economy, so I'll put oil aside for a while, just looking at the non-oil sectors of these economies, of the GCC. We have a quite resilient and robust GCC non-oil sector that has been growing at about 4% for the last couple of years, despite the global shocks that we've been experiencing, despite tariffs, despite geopolitical shocks, etc. And this is because the key drivers are from within and are not impacted by the change in global factors. So when we look at Saudi specifically, investment growth is still the key driver of economic activity. We're seeing a very elevated level of investment that goes into the Saudi economy on a yearly basis. Now, if you open any sort of newspaper, read any sort of wire view on Saudi, you'll read a lot about recalibration of projects, the NEOM projects of the world that have been scaled back or revisited or recalibrated, whatever the word of the day is. But in the data, in the actual investment quantums of the Saudi economy, this is still a G20 economy that is above $1 trillion in size, where there's about more than $100 billion of investments that goes into this economy every year. So when we add up what Saudi spends on investment in infrastructure, on budget, on its own Ministry of Finance budget, when we add to that what the Public Investment Fund, PIF, the Sovereign Wealth Fund, what it invests in the Saudi economy every year, which is about $40 billion, 40, and when we add the FDI that Saudi, for example, received last year on an annual basis, it was just over $30 billion, we're talking about $100 billion of investment from the private sector and the public sector that go consistently into this economy every year. So this is above 10% of Saudi's GDP. So one cannot argue that investment growth is fueling non-oil GDP growth of about 4% in Saudi Arabia. And the size of the non-oil sectors have already reached about $700 billion. So this is, larger than many big economies we know of in the world, just the non-oil sectors in Saudi Arabia. And this is almost 70% of real GDP. So when we talk about diversification in Saudi, yes, it is happening. Yes, it is a long-term process. It will likely take many decades, multiple decades, for Saudi to eventually say that it is fully diversified away from oil. but the results and the outcomes are already visible within the data, and the opportunities for the corporate sector and the financial institution sectors remain very ample despite the readjustments in the plans as we go, given the reality of lower for longer oil prices. So when we compare that to the UAE's outlook, the UAE's outlook is very different. The investment cycle in the UAE has reached a more mature stage. The UAE doesn't need to invest in infrastructure as much as Saudi does, despite the fact that there are still very, very ambitious population growth plans within Abu Dhabi and within Dubai. So the population growth in Dubai and the UAE is now averaging 6 to 7% year on year, meaning that every 10 years, the UAE doubles the size of its population. So that brings about with it a natural, organic level of investment for housing, for roads, for connectivities, for school, for setting up the infrastructure to enable and accommodate this doubling of the size of the population that we've experienced every 10 years. So really for the UAE, the transformation that is ongoing in the UAE is one of domestic demand transformation. Saudi Arabia naturally is a larger country with a larger population that has its own domestic demand strength. The UAE is building that through decades of attracting expatriates, and it's slowly but surely becoming a domestic demand force in and of itself. So consumption growth in the UAE, we believe, will continue to fuel economic activity in addition to trade activity, as that has been the key engine of growth specifically in Dubai. When we compare Dubai to Abu Dhabi, the key growth driver in Abu Dhabi recently has been financial services. So it's no secret to anyone how many funds and how many asset managers have relocated from London to Abu Dhabi in the last couple of years. So that is clearly showing in the data. And that has allowed Abu Dhabi's population to cross over 4 million people. And then in Dubai, the population has just crossed over 4 million people over the summer, and the key driver of economic activity remains the trade, so wholesale and retail trade, those trade corridors that we were talking about, and consumption growth as well. So in terms of the sectors that we really keep an eye on, these are trade, logistics, manufacturing, but also AI. So I get asked a lot about AI in the context of the GCC-US relationship and the future of the GCC. And we get asked this question in the context of competition. So there's this clear concern that Saudi and the UAE are outperforming the global economy. They're both key economies to monitor, but there's a concern that they may be competing with each other on similar lines and similar sectors. For AI specifically, we don't believe that there's a direct competition in the sense that, yes, both countries may be building data centers, may be pursuing their own AI strategies. But the difference between Saudi and the UAE is that Saudi is looking to adopt AI as a productivity enhancer for its economy. So Saudi is already it's already performing at maximum capacity in its investment plans and in its labor dynamics. So unemployment rate in Saudi Arabia is at a record low. The labor market is creating jobs at about 1 million jobs per year, which is the highest that it's ever been. And so labor and capital in Saudi Arabia are performing at the maximum and full capacity as they can. So adopting AI use and use cases can help with productivity, ensuring that growth is even higher for the same quantum of labor and of capital. For the UAE, the strategy is entirely different. The UAE is looking to be the data center powerhouse of the world, where it wants to use its own energy to create cloud capacity that it can rent out, for a lack of better word, to other economies that may have these constraints on energy capability to power their data centers. So it's looking to export this service. It's looking at it from an export strategy rather than from a domestic productivity strategy. So it's similar plans, but for different objectives, which will end up yielding a result that this AI tide will lift all boats within the GCC, in our opinion. Now, the rest of the GCC economies, such as Bahrain, Oman, and Qatar, are also growing positively, but at slightly slower rates than the likes of Saudi and UAE, where we're seeing growth rates at 4% or above. We're seeing non-oil growth rates in Bahrain, Oman, Qatar being a little bit more subdued, but still in the very positive space. So in the final section here, my final point, I'd like to talk a little bit about FX risks, because this is obviously something that we have to keep an eye on, not just because of the dollar value. So our view is that, as I expressed at the beginning, we don't think that there's a structural de-dollarization trend that is ongoing where people are just dumping financial assets in dollars to move to other developed markets or other emerging markets. While that may be true, there is very good global risk appetite for emerging markets, notwithstanding the fact that that dollar is relatively weaker. This environment of a slightly weak dollar and falling interest rates in the US in the short end and relatively low oil prices have helped contribute to a positive global risk sentiment towards emerging markets, where the likes of Egypt, the likes of Turkey, the likes of Kenya and Nigeria are attracting inflows, foreign portfolio inflows that are helping their own FX liquidity and helping also support their own FX rates. So although we monitor, obviously, the fluctuations in the global FX and the dollar value, idiosyncratic drivers have emerged as equally important as well. And each of these economies have their own risks that we need to monitor. So when we look at geopolitics today, we're very close to, or we think we're very close to a Gaza ceasefire that could have positive economic ramifications, almost immediate positive economic ramifications for countries that are in close proximity. So here, if we think about Egypt, Egypt has been losing Suez Canal trade revenues of about $4 to $5 to $6 billion every year because of the Houthi attacks in the Red Sea. Once this Gaza ceasefire is complete, and if it does end up being completed, we could see Egypt regain those trade revenues quite quickly, and that could be a huge support for the Egyptian pound going into the end of 2025 and going into 2026. So these really idiosyncratic geopolitical events have quite a large bearing on the FX outlooks of these various economies. When we look at Turkey, for example, in March we had a huge volatility episode in FX and in inflation in Turkey as a result of a domestic political, let's call it, incident. This is likely to, the domestic political volatility is likely to be repeated. How markets react to it is a big unknown, because markets have grown more and more fatigued of not knowing how to price what they don't understand, specifically when it's about idiosyncratic domestic political risk that they have to decipher and allocate a lot of resources to try to anticipate and study the impact of these political risks in the long run. So what this ends up causing is an exodus of capital, a capital flight, an exit that weighs on the currencies. So in Egypt, we monitor the Gaza ceasefire. In Turkey, we monitor domestic political instability, although elections are still a few years away, but still in advance of that, there are domestic political events to watch and key dates to watch in Turkey. And in Pakistan, similarly, the impact of the floods is a factor that we continuously monitor, specifically as Pakistan is under an IMF program and has to contend with specific targets to continue progressing in its IMF program. So the floods will obviously complicate this outlook and cloud this outlook with regards to remaining on track. But otherwise, Pakistan is one of these economies that we always set as an example of how it bounced back on its FX liquidity when reserves, foreign currency reserves at the central bank had dropped to about $3 billion a few years ago and are now back up to $15 billion. This is a key turnaround in FX liquidity in embedding resilience to external shocks and to climate shocks, such as the floods. Turkey has done something similar. Turkey has rebuilt FX reserves to make it more resilient to these shocks. Egypt has done the same thing, rebuilt FX liquidity, whether at the commercial banks or the central bank to also make it more resilient to these shocks. So what we end up seeing is that emerging markets are the ones, and frontier markets, are the economies that have been tested and have embedded more resilience and more buffers in their domestic economies, whereas developed markets have been a bit more complacent given their status, and we're now talking about fiscal risks in the US and the problem of the US debt, and that is weighing on the rest of the world, when our economies in emerging markets are the ones that have been fixing their specific fiscal outlooks and reforming in a way, often under IMF programs, in a way that makes them more resilient to these global shocks. So what we should expect for the more long-term horizon is a little bit less sharp boom and bust cycles in these economies. Not saying that we won't have upturns and downturns. We will likely have upturns and downturns. But the same way that the UAE has not had a housing market crash, famous last words, the same way the UAE has not had a housing market crash since 2009 because of the reforms and the fixes that the government has implemented since then, we will still likely have ups and downs and periods of growth and then periods of corrections. But those reforms that have been embedded for the last 5 to 10 years to 15 years in some places make these economies slightly more resilient to their own domestic shocks and also global shocks. So this is where I'd love to end, on that sort of balanced note where we're quite constructive on the global and the regional economies, but with a key eye on the domestic and geopolitical risks that could have positive or negative effects. And I will check in to see if there are any questions. I haven't seen anything pop in on my screen yet. I'm not wearing my glasses, so I can't see what you're pointing at me. Oh, there are questions. OK, perfect. OK, so you can't see them, I can see them. So I will read them quite quickly. So first question is on US interest rates and US inflation. Can interest rates be reduced despite rising inflation due to US tariffs? And if so, what should we expect? So yes, our forecast is that we see the Federal Reserve looking through higher inflation in the US. So despite the fact that we think there will be higher US inflation, we expect the Fed to ignore that to a certain extent and continue cutting interest rates until the end of 2026. So as a bank, as a research team, we see 2 more rate cuts of 0.5% until the end of the year. And then we expect the Fed to remain on hold for the rest of the year. The market is expecting many more rate cuts than that. And the market is expecting a total 125 basis point rate cut, including the one that just happened in September. So this is an interesting question on the consumer. So what are the optimal economic conditions to boost consumer demand, and when do we expect to see them again? So there are 2 things I want to bring up here. Obviously, lower interest rates can help consumption growth and can help the consumer. So that's pertaining to the US consumer. But generally, the global consumer also wants some predictability. So this is tying it back to the theme I brought up in the beginning about unpredictability. Unpredictability doesn't make for a good environment to make investment decisions or consumption decisions at a micro level, so at an individual level, but also at a global financial institution level. So we believe that the optimal economic conditions to boost consumer demand is both a combination of lower interest rates combined with more predictability in geopolitics, in policy, in monetary policy, and fiscal policy. The other question is about the weaker dollar. So how does a weaker dollar interplay with deflationary processes? Should we expect further downside pressure on cotton prices if consumer goods prices fall? So look, I'm not a commodity expert and definitely not a cotton expert, but our outlook on the commodity complex in general is quite constructive. Now, I know that on cotton specifically, there are very specific demand and supply considerations, but if we look at the commodity complex in general, because we don't expect a global recession from a demand perspective, we think that global demand should remain quite constructive. Now, cotton has its own supply considerations. I will not comment on that. But in general, we are quite constructive commodity prices. This is why we expect gold prices, silver prices, precious metals to still do well. But similarly for oil, because we see much more supply of oil, we are expecting that due to supply factors, oil prices should remain in a range of $65 to $75 for the next 2 years. So the ceasefire might appreciate the Egyptian pound. Do you not anticipate a devaluation on the Egyptian pound to comply with IMF requirements? That's a great question. So yes, previous IMF requirements have come with an Egyptian pound devaluation, not because it was an IMF requirement per se, but because the FX market in Egypt oftentimes stopped functioning as liquidity dried up. So if I just take the latest episode, in the period between 2022 and 2024, there was no FX liquidity specifically for corporates, for foreign corporates, for multinational corporates within Egypt, where access to FX liquidity was severely restrained and restricted because of a shortage in FX liquidity and dollar liquidity. This is why the IMF made it a requirement to restore functioning FX markets ahead of the IMF program. So it's not that the IMF will force devaluation, it's that the IMF will force the FX market to remain open again for companies to activate the economy. This time around, we don't see a clear FX liquidity downtrend. On the contrary, the Egyptian pound is strengthening already. So if we look at the Egyptian pound in the last few months, it went from $EGP 51 in April to $EGP 47.7 recently. So we've seen a few percentage points appreciation in the Egyptian pound because FX liquidity keeps coming to the country through FDI, through foreign portfolio inflows, through investment from foreign investors into local currency debt markets. So that has been quite constructive. So we expect Egypt to remain on its IMF program, and we don't expect the IMF to force any conditions of devaluation as long as the FX and currency markets are functioning and are open for business. That should not trigger any sort of IMF restrictions. So question from Uday on AI. So you mentioned global GDP will slow down next year. What is your view on AI acting as a catalyst to improve total factor productivity and continue growth? So actually here, I want to take Uday's question and take it a step further. Because since we're talking about trade and supply chains, there's this big expectation that tariffs is going to eventually lead to falling volumes in global trade. So I mentioned before that our view is that intra-regional trade will increase, but trade between the big global economies, east to west, might decrease. So this might lead to volumes of global trade, specifically on goods trade, decreasing, but services trade is actually outperforming quite significantly. And this is driven by AI, and it's driven by total factor productivity, as Uday mentioned. And it is helping not just support growth in many economies, but also support trade growth from a services perspective as well in many economies. So a question from Amit. So this question comes back at every conference, and it's one that I love. It's about quantitative easing and historically. So the large amount of money printed during COVID caused upward trend in commodities. How will this extra money be removed, and what will be the impact on commodities? So Amit, you're absolutely right that quantitative easing lifted asset prices across asset classes, not just commodities. And we've had this question that there's a lot of global cash sitting on the sidelines. There's a lot of money out there that doesn't know where to park itself. Equity markets look expensive in various parts of the world. People are expecting market crashes in various places. So we're still in an environment of ample global liquidity conditions where monetary and financial conditions are not tight, and if anything, with the Fed starting to cut rates, we're going to see even easier money. Now, how this translates to commodities, I think commodities will continue to be driven more by fundamentals, by demand and supply for key commodities, rather than by these big global shifts as the Fed is cutting rates. Now, if this was a situation where the Fed was starting to increase interest rates, and we were talking about tightening, then I would be concerned, as you clearly are in your question. So we have a few minutes left. I'm going to take one last question. And I'm going to pick the one about a global digital currency and implications for commodities trading. So this is a question I tend to get quite frequently about denomination of whether it's oil prices or any other commodity in dollar. Because a few years back, and every now and then, we keep getting these sound bites in the media about potentially oil prices or other commodities being denominated in contracts other than in the US dollar. And various oil producer or commodity producers accepting other local currencies in exchange for trading in those commodities. From our perspective, we don't think this is going to lift off. We don't think there is a clear economic rationale, a clear economic case for denominating commodities in anything else than what they are currently denominated. But we do see the evolution of bilateral trade within emerging markets transferring to bilateral payments in local currency. So it's already been a use case, and we've already seen adoption of countries trading with each other, whether it's commodities or otherwise, and accepting local currencies, not the dollar, in exchange for that trade. So this is more pertaining to intra-regional and intra-EM trade rather than this idea of changing the de-dollarization and changing the denomination. On the introduction of a global digital currency, I think we're quite constructive on stable coins. We think that there is demand globally on something that gives access to a dollar deposit effectively that is backed by US Treasuries, even if it's not an interest rate bearing, let's say, account. But still, we think that there's demand globally, specifically from emerging markets, for these sorts of, I don't want to use safe haven, but these sorts of products that can give access to dollar-denominated US Treasury-backed financial solutions that are digital and that enable cross-border funds, especially in countries that have a history of facing repatriation issues and liquidity issues in their own domestic currency and economies. So I don't know that it would be a global digital currency, but we do see the adoption of stable coins by various global economies, and that's something we are quite constructive in. So on that, I will stick to my time, and thank you very much, everyone, for listening. It's been a pleasure to take your questions and to share some thoughts from our global research insights, and have a great rest of your day and your agenda. Thank you very much.
Carla.